The hardest thing about being a contrarian is knowing when to allow the market to catch up to you. You don't want to be a contrarian for contrarian's sake, right? How do you stay long enough at the party, especially when more and more of the return comes less from just that valuation normalization and more from how many people are going to jump into the pool? How high is this going to get? How frothy is it going to get?
All right, Money Miners, we have a returning guest, Brian Lax of Old West Management, who, when you last came on, we dived into uranium, tin, a whole bunch of niche kind of metals. You, of course, were very early and successful on the uranium trade, Brian, and you're a self-professed contrarian, so I think that's the perfect spot to start the conversation. What are you seeing out there that's really presenting the most amount of value to you at the moment?
Yeah, well, first of all, thank you guys for having me. And like we were joking before we started here, I think we finally are in an environment where a lot of these things are working. And so to switch over to some of the things that are on the contrarian side, I'm happy to do that as well. But it's it's quite a different environment than it was a few years ago, where any commodity that you touched was kind of contrarian because everything was out of favor, especially 2022 into 2023 is, they started raising rates, China shut down. I think here in 2025, we have seen a lot of things start working, especially gold and some of the other metals. But I think there are still a few areas that are out of favor, where we're really trying to get up the learning curve and, maybe start to dip a toe in. I guess probably two off the top of my head would be maybe coal and lithium, which both had, huge runs last few years. Obviously gave a lot of that back, the last year or so, especially on the lithium side. You never like to call bottom on anything, but it does look like the long-term fundamentals are setting up pretty nicely and still working through some short-term headwinds.
I'm so excited you've mentioned them because I jotted them down as commodities that I haven't heard you speak about in the past. So I'm curious to start with, have you actually initiated some positions in some of the coal players or the lithium players, or just doing your homework and getting a feel for the space to start with?
A little bit of both. Dipping our toe in a little bit, kind of getting up to speed on the whole environment, all the different players. But, similar, and I'm sure we'll talk about with other commodities. When we look at all of these different areas, we're looking for, okay, is there going to be a supply-demand mismatch somewhere, either now or in the future? And then who are going to be the companies that are able to supply into that? And with all these commodities, it's who's got scale and who's got great. I mean, where are the large, low-cost sources of supply? Because in the long run, that's really what's going to matter. And if we can buy into those types of companies when there's a short-term or, multi-quarter kind of downturn, I think that's where we get the best return. And we saw it in uranium 5, 6, 7 years ago when all these things were trading for nothing. And that's when we're usually doing the work, building positions, and then, fast forward 5 years, we're harvesting and, we still maintain a lot of the things that work, but really looking to rotate into some of these other areas that, might reset the clock a little bit and give us a nice forward, 2, 3 years.
If you take that kind of lens, so you look for where the large low cost supply might come from. Take lithium for example. The lowest cost producers that are Western names. You've got ALB.NYSE, who's got the worst balance sheet in the sector, and then SQM, where you kind of need a resolution of events with the Chilean government to see maybe a pathway where a large investment can be comfortable in some respects. So do you put a line through them for those reasons, or do you actually think they're interesting situations for those reasons?
It really depends on, what sort of components of return you're looking for. I think when money starts flowing back into the space, it naturally gravitates to some of the bigger, more liquid names. We saw that in uranium, looking like a Cameco, where it didn't really see a pullback off the 2021 highs. It just kind of kept trucking along, where some of the more junior projects, did retrace and then took a second shot higher. With lithium, I think we're looking at it kind of the same way. Are there big development projects? Who's got the big sources of supply? It might not necessarily have to be a producer today. And so I think the way we look at it is, well, we're not really certain when the next cycle takes off, but we don't necessarily need to have someone in production today because and you kind of go down the producer developer curve, but where do we want to position ourselves, especially if we're not kind of jumping into the sector with both feet right away. And so I think we do have the luxury of time. I don't know if we're near bottom, past the bottom, whatever it is. And I've heard some of your recent guests opine on that. But I think this is a great time for someone who has a longer term perspective, a few years where they can wait to really say, okay, who are the largest low cost sources of supply, whether in production today or in development, and what are they trading for? What's baked in? And if we have a different view of what the pricing environment looks like a few years from now, who's going to benefit the most given where they're being valued today?
So you really speak to this kind of top-down approach, Brian. By that nature, do you always tend to play the portfolio approach when you come into the commodity and pick a handful of names? Like, obviously some commodities that's harder. We spoke about tin previously, where there's a very small number of companies you can play it in. But by and large, do you prefer that portfolio approach to it?
I think that kind of goes with how far you are up the learning curve. Well, with uranium, it was different because the sector was so washed out that you really could just pick any of them. I mean, all of them were, $50 million market cap. I mean, there are a few larger ones, but for the most part, everything was so distressed. I mean, this was when uranium was 20 or 30 bucks a pound, right? And so you didn't really need these heroic assumptions. You said, hey, if we can get to 50 or 60, a lot of these things are trading very cheaply. And we didn't necessarily know which ones would perform the best. I mean, I think there's a bit of a path dependency there. So we did build a basket. At the time there weren't a lot of, there was one ETF and it had some construction issues with it. Today it's a lot different, at least for uranium, where, there's a half a dozen ETFs and, maybe 50 or 60 companies. Now I can't even keep track of all of them. But for something like a lithium or a coal, I wouldn't call it building a basket, but maybe one or two stocks or three. I guess I don't know if you want to call that a basket, but who's a big producer that's down and out. What are a couple of big development projects that might look terrible at today's price, but if you get a normalization, wow, these things actually look good. And I think we like projects that turn into actual mines in production. I know people can probably make more with some torquey type of way out of the money. I mean, we saw that with uranium. Hey, those stocks did well too, but I think for just the way we operate, because we're a little bit larger now, and so we need to be able to move kind of chunkier pieces of capital in and out of these things. I think you really want something that gives you more than one way to win, not just, hey, we're going to get a levered play to the commodity reflation, but this thing might actually be a mine, and in various assumptions, various scenarios, it actually looks pretty compelling based on where it's trading today and what we think the environment might be, a couple of years from now.
How do you do that with coal? There's not too many new coal mines being permitted.
I always feel like a tourist when I listen to the coal guys talk, and it's just, it's hard. I think there's a handful of names you think that are considered high quality. I think really it's a very similar type of analysis, which is, you had this big run a few years ago, and then it all kind of came back down. You had a lot of things weighing on their end markets, China and steel in particular. Does that mean it's over, or does that mean, we need to chew through kind of this current environment before we can see demand pick up, whatever it is in a year or two into the future? So you look at, I mean, it's very similar. Who are the low cost producers? Who are the large producers? Where do you want to place your bets, whether it's thermal or met? I'm no coal expert by any means, and so I'm sure you'll get a better answer talking to different people. But you ask, where are the contrarian areas where I see current sentiment out of favor, but I can make a case that the long term actually looks better? I think those are two great examples, and partly because a lot of the stocks are down 60% off their highs of a couple of years ago.
So if we reflect on the uranium trade you've mentioned there a few times, Brian, this is like the best example of your guys' strategy and how it can play out. Where do you think we are in terms of it fully playing out right now?
Well, I think, it's definitely a different environment. What a difference 5 years makes, right? I mean, a lot of these things are up fivefold, tenfold, just sort of crazy amounts of enthusiasm, froth. I don't think it's the contrarian trade that it used to be. Maybe doesn't have the same level of asymmetry unless you believe in some, nuclear renaissance, where we're going to start building hundreds of reactors around the world. when we first got into it, and we did a lot of these types of podcasts, 5, 6, 7 years ago, as we were building positions there, we weren't baking in the idea of a nuclear renaissance. It was just at the current, slate of reactors, the builds that were on the table, there's just not enough uranium, and the price was too low for more supply to come online. And so it was a simple economic, hey, the price has to go up. At the time we were like, oh, 50 would be great, right? And 60. I think that was a lot of these things looked really good. So today, with where the valuations are, I think one, you have to be a lot more selective, and two, you may have that same asymmetry if you do believe in just a huge nuclear renaissance, or a lot of flows of money into the sector, and you get this kind of valuation expansion, which you may have as well, because now the tech community is getting involved in there, and you see people saying, "Oh my God, we're going to have a reactor on every corner." If that's the case, yeah, you can probably make a picture for that much more upside. But it was a big part of our portfolio 5 years ago when everything was washed out. We still own a lot of it, but I think it's more concentrated, kind of the higher quality names, and we're not necessarily baking in all the extreme bull case, even though it might happen, right? Yeah, you get the $200, all these people are crazy now about what they think is going to happen in the space. I think we think are good, high quality projects, and it's going to sound like a broken record here, but who's got the big, low cost sources of supply that can come on, now and into the next 5-10 years? I think those guys should do well, because I think, yeah, the price has gone from 20 to wherever it is now, 70, 80 a pound. We think it probably still has to go higher. I think you're going to start to see the long-term price start marching up, and whoever can really sell into that is going to do well. But you do have to be a little bit more selective. I mean, it's pretty wild to see some of these companies that had, 100 million, 200 million market cap 5 years ago now having, 5 billion. It's just, it's like the Wild West out there. I think, there's a lot of these nuclear adjacent tech type names that are just seeing these crazy valuations. And so, we kind of watch it and say, oh, it's like seeing like one of your kids grow up, right? It's a whole different environment, but I think there's still a long way to go for the whole uranium nuclear thing. We still think it's a great way to generate electricity. We're going to need a lot of electricity. It's going to be part of the portfolio approach of generating that. The real question is, what sort of environment is being baked into these valuations, and do we want to participate there, or do we think there's other parts of the commodity sphere where we can get better go forward returns?
What is your allocation to uranium and then non-uranium commodities as a percentage?
I'd have to check. I think, at one point, we had the cap, it was like 30%, 35%, and then that was before it started running, and it was basically going up faster than we could trim it. Today I think it's much more reasonable, maybe 10%, 15%. I mean, I'd have to check. We have a few different funds, and it varies, but certainly not as large as it used to be. Partly because, we did have a pretty large basket of them 5 years ago. I think now we've kind of cut that down to a handful of what we think are the highest quality. And, they're the household names you think of, the large producer, the large developer projects. I mean, it's not rocket science here. I think, maybe you could get kind of cute and go into some of these more niche areas and try to squeeze something out. But again, we're not trying to speculate on a massive nuclear boom. I think to get real significant upside out of a lot of these things, you might need that, especially given where some of them are trading. So, I mean, we're I guess pretty conservative now in our allocation there, but just because we see that same setup in a lot of other commodities that we saw 5 years ago, and these other places are not nearly in the same level of re-rate that we've seen, where some of these stocks are up tenfold.
Whenever it is like a bottom for a commodity, or max capitulation or whatnot, there is always a narrative that is like big and loud about why things will get worse from where they are right now. Like how do you get comfort, entering some of these like commodities when it kind of could be the bottom, but there's a lot of noise and good reason to think things will get worse from where they are right now?
Well, I think that's the contrarian nature right there. You have to be careful trying to call a bottom. Hands are scarred from catching falling knives in a lot of these things. Uranium was a great example. I mean, it bottomed in 2020, and we were building positions in 2018 and 2019 and losing money. And so it was like, you got to have an investor base that kind of gives you the benefit of the doubt that you're doing the right work. You have to have done the work to have conviction in where you think these things are going. And if you're correct and that long-term outlook doesn't change, well, you should be buying more as they're getting cheaper. And I think that's what you're seeing in some of these other areas that are washed out right now is, yeah, I mean, you might have had that bullish view on lithium a year ago, and I think some of the stocks have been cut in half. And so it's difficult to try and call the bottom, which is why I think in these types of scenarios, we usually leg into the positions. I think we're have enough humility to know we're not going to call the bottom to the day. So if we can kind of build positions on, a few quarters before, a few quarters after, you're going to catch a nice average price in there. And if you're right about the potential upside, it's not really going to matter. I mean, I think you do have to have the investors that are not going to, pull their money if you're down after a quarter or 2 quarters. Yeah, and now we have the benefit of having done it a few times where we've shown this kind of longer term thinking works. And so we do have the investor base that'll give us patience. I mean, just in the last year or so since we've talked, two of our largest positions have been acquired, FILO and Adriatic, which I think we talked about on the last show. So it's nice to kind of have a few things in succession where, hey, we made these bets 5 years ago, and then a few years go by, we harvest them, make new bets, and then a few years go by, we harvest them again. And I think you can show that repeatability there. But yeah, if you don't have that track record, it's going to be hard, a year into the trade and you're down 20, 30%. People are like, do you know what you're doing? Like, what's going on here? And so I think you do have to have a bit of that mindset and, set your expectations correctly. This is certainly not the multi-manager, what's going to happen next quarter, try and game it. We don't do any of that stuff. In fact, we kind of like the ones where people are actively negative on, because that's typically means they're going down for some reason. And if we can have a view that the next few years looks better, well, that's when we probably start building positions.
And uranium hasn't been all one way since it started going in your sort of favor. So the last year has been a bit rough. Did you use that chance to top up, or you just sort of hold on to that core position?
Yeah, no, we did. We lightened up a lot in call it late 2021 when you had that first, real frenzy, right? 2020, at the end of 2020 is kind of when the move started, and then throughout 2021, Sprott came into the market. You kind of got into the summer, fall in Northern Hemisphere, and it was, Wall Street bets. It was on CNBC. You got the price going to like 50, and I think a lot of these things really had that first big impulse. But we got to, whatever that was, September, October, November timeframe, and we just said, man, a lot of these things are already pricing in, $70 or $80 a uranium. And remember, we had a huge weighting in it. So it was like, well, let's dial this back, because these things may have already gotten ahead of themselves. And sure enough, I mean, there was this big digestion period that happened, kind of late 21 into, call it 23, then you started to have these things tick back up as the spot price, caught up. And then, early last year, and it got above 100, and there was that kind of that wave of enthusiasm, and then completely retraced that into earlier this year, to where we saw sentiment as bad as it was, back when we were, looking at it in 2017, 18, right? And so we did take the opportunity to top up on some of these things, because the way we looked at it was, now, wait a minute. A lot of these stocks are, this was, call it, first quarter of the year was a pretty bad quarter for uranium stocks. A lot of them were trading below the levels that they set in 2021. And here we are, 3.5 years later. So, well, now, wait a minute, the price is much higher. And these companies are 3 years closer to production, or wherever, on their timeline. And yet they're trading below where they were before. And so we said, well, this doesn't make any sense anymore. And, kind of like how, I guess it's a little bit of zigging when the market's zagging, right? I mean, when the things were flying, they're all over TV, we're lighting it up a bit. And when, these diehard uranium investors are, throwing in the towel, then we're like, wait a minute, we'll take a little bit and add to that. And so I think that's worked for us in the past. And so, yeah, it's, now here we are again. Look, I think the uranium trade still has a lot of legs. It's just, what sort of level of enthusiasm do I want to underwrite from here? I think we do a lot of what I would call sort of separating what our expected return components are going to come from, whether it's just the pure valuation, or whether, it's going to be money flowing in or multiple expansion. I think when you get to some of these frothier eras, I think more of the return is going to come from those subjective things versus, I don't want to call it the easy money, because it was hard to be made, but kind of the early money off that very bottom, kind of coming up into that first inflection. I think that was captured, and now it's a bit of a more balanced risk reward from here. Like I say, you have to be more selective, and then it's how big of a renaissance do you want to expect?
I'd love to hear your thinking around this, because yeah, the best risk reward is to be set up and waiting for that first inflection up in any commodity. But oftentimes you see that first inflection up, you didn't have a sufficient allocation, and you think, oh damn it, I knew I should have bought like a month earlier or whatnot. But there's often still a lot of legs to go. Like take the kind of PGM complex at the moment. You've seen a lot of green shoots there, and if people don't have an allocation and think I've missed it, but then there's this pattern in commodity cycles that you see a little some legs up, and it doesn't just like fizzle out there. You often get these boom bust kind of dynamics.
Yeah. Well, and I think that's why we do spend so much time looking at the ones that are out of favor, because I think that's where you can actually spend time to learn the industry. You can start to build positions. You might still be buying it on the downswing, but I think look, there's a lot of different schools of thought there, right? Some people say I want to wait until it shows me that it's starting to work, so I don't have to take that pain. We had a lot of guys in the uranium thing, when it was $20 saying, hey, call me when it's 30, right? Like I want to see it start working. So I mean, there's different ways to do it. How much pain threshold do you have? Are you willing to get into something when it looks like maybe there's still a quarter or two of bad news ahead? We are. I think there's a lot of investors out there that do not want to take any sort of drawdown, and so they avoid these types of things. But I think that's how the mispricings get so severe, is people are like, oh, I don't even want to look at this thing until it starts turning. We're happy to start, like I said, we build positions over time, and then we scale out of them over time, right? When the environment changes. Look, we have to be right still. I mean, we have to say that, hey, today's environment is going to look a lot different than the future. Otherwise, yeah, you're catching the falling knife. But I don't think we mind as much to be a little bit early, because if we're right, we're probably buying just as much on the early side of the bottom as we are, coming out of it.
How do you think about the changing incentive price in uranium as well? Because that's sort of increased dramatically over the past 5 years as these restart projects have struggled to come online, and there's been delays in new projects. So what's your thinking around that at the moment?
Yeah, I think it just keeps marching higher. I mean, you see the inflation, you see all the on the capex side, opex, the delays. Where we used to think, hey, 50, 60 looks pretty good. Now you look at some of these higher cost projects, they probably need 80 or north of that, and we're kind of right around there, right? And so it's like, okay, well, you can give the green light to some of these projects, but then it's just a timing issue of how long it's going to take them to be built, and then we'll see if that's truly what their break even is when the production comes on. I think we saw that a lot in copper, where these guys said, oh, look at our deck, and you make this great IRRs at $4 or $4.50, and here we are at $4.50, and nobody's making any money. And so it's like, wait a minute. And so look, I always think the bias is, it's mining, right? They're cost overruns, timing overruns. And so you have to think whatever your idea is of that break-even price, by the time you get to the production, it's probably going to be higher than that. And so I think it just continues to creep higher. I don't know. I mean, 80, there's some companies that make great money at 80 here. And so that kind of goes back to what we were just talking about, which is, who are the low-cost suppliers? Sure, they're not going to have that crazy snap leverage of the guy who is break even today and goes infinite profit on the next dollar, but we can sleep better at night, not needing to worry about that kind of stuff. I think you can have a little bit of that in your portfolio, but if you base load your portfolio with just the really high quality names that can make a buck in any environment, I think you're going to do well over the long time, especially if you're right on the commodity price. And so that's really how our portfolio looks today across all the different commodities we're in. It's not like, I mean, we do have some of these more niche kind of development stage companies, but for the most part, it's what you would expect. And so I think more of the value is in saying, when should we be in these different areas? That's where it kind of goes to that kind of short-term contrarianism versus the long-term, real strong fundamentals. And if you can layer in enough of these types of payoffs so that they kind of overlap each other, you're not just having your entire portfolio waiting 3 years for everything to hit at once. You get this sort of sequential payoff structure where you can be harvesting in one area, deploying in another area, and it kind of smooths out the volatility. And so I think, we like to have things in our portfolio that are currently working, that are about to work, that, might be a few years from working, things that are going down that we can keep buying. And so if you have a balance of all of that, you should kind of smooth it all out, and then your long-term returns actually look pretty good.
Let's talk about copper then, Brian, because you identify as a contrarian, but I think you've got a consensus you want copper.
What's that? That it's going higher?
Yeah.
The hardest thing about being a contrarian is knowing when to allow the market to catch up to you.
Yeah.
You don't want to be contrarian for contrarian's sake,
For
right?
sure.
I think probably that's been the case, is how do you stay long enough at the party, especially when more and more of the return comes less from just that valuation normalization and more from how many people are going to jump into the pool?
Yeah.
How high is this going to get? How frothy is it going to get? And look, yeah, you probably want to have a little bit for that, but it's harder to justify a real solid weighting in something when more and more of that return component comes from subjective things like that. And so copper, yeah, maybe it is consensus. I don't know. I mean, I think copper looks great here. I think it's going to continue to surprise to the upside, especially like we were just talking about. All these guys that claim, oh yeah, our project's so low cost, and look at this, and then who's making the money here, right? And so I think you're going to need. Well, I mean, this is just kind of, it goes for a lot of these commodities, but the demand continues to grow. Supply is pretty shaky for a number of reasons. And so that's just a recipe, I think, for continued higher prices. And it's great. We love seeing these companies come out and be like, oh, yeah, 450's here, but we're not really doing too well there. Maybe we need 5. And then, let alone the greenfield and, brownfield expansion stuff. I think you're going to need higher copper prices. And if anything, I think, I mean, what's the copper price up this year? Nothing, 10-15%. I mean, I think where it has to go, especially if you're looking out a few years, right? 3 years, 5 years, 10 years, we're going to need a lot more copper. I don't think the current price is enough for that. And so, I mean, look, we've placed our bets. We might be wrong. Yeah, I don't know. Maybe we're wrong. So that's fine. I think people agree with us, at least the ones that invest with us agree with us. And so, and again, it's we're not necessarily needing to call for, these. You remember it was a year or two ago when they had all these crazy call at 40,000, ton copper and all this stuff. That's not us. I mean, look, that'd be great if it happened, but I think it has to go, it has to go higher than we are today. What's it, 450? I don't know, 5, 6, I think would be a nice price to really stimulate some more production. But we still like the large, low-cost sources of supply because they're going to do well today and probably in that environment too. We always like these situations where you need the marginal projects because that means that the guys that are good projects, I mean, are going to earn that sort of bumper margin. And so if you were to look through our copper portfolio, it's a lot of these large, low cost source of supply. We talked about FILO last time. They got acquired by LUN.TO, and so we still like what they're doing down in the Vicuña. I mean, I think that's a perfect example of how we look at things. Is that's going to be a 100-year district. I mean, it's going to take a ton of capital. Who knows what the break evens are going to be, but it's very large, very high grade. BHP's in there now. I mean, I wouldn't be surprised if BHP ends up, owning the whole thing at some point. It's the LUN.TOs have done a very good job of, consolidating that whole region, putting all the pieces in place, kind of making sure all the entities have the different. I mean, it really is nice to see what they've done down there.
The NGEX royalty as well. Like, how cool
well,
is that?
So a lot of people think, hey, does that mean that they're prepping
Yeah,
themselves for?
I can see that. Yeah.
Look, Los Helados looks great with as future feed for Caserones, right? And LUN.TO stepped up; they exercised the option, and so it's like all these little things in isolation, they don't show anything, but kind of in aggregate, you can see them putting the pieces together. Yeah, and then obviously the NGEX discovery is just, I mean, it's kind of absurd the grades that they're hitting there.
I like your theory there as well because remember the talk about a potential royalty spin out of FILO kind of in the lead up, and presumably BHP did not have any appetite for a royalty to be part of that deal. So if you want to create a royalty spin out, knowing that a consolidation is coming, well, you've got to do it now as opposed to wait for a bid to come. So yeah, maybe.
Well, that's right. And I think NGEX is kind of in the same place FILO was at a year or two ago, where they keep putting out these barn burner results and the market's like, okay, well, yeah, we get it. You got a lot of high grade stuff there. I think people are more concerned now, or at least the market is, with what is the sequential path to development? What are the entities involved? Who swallows who? You know, how are the pieces put in place for this to actually get developed? Because it's going to be I mean, it's a whole district, right? It's going to be a massive multi-mine, multi-decade type of runway. You know, our big question is, does Lundin Mining want to keep the Lundin name out there and operate independently? Or, you know, look, BHP's made no secret of the fact that they want to get bigger into copper. Obviously, they've taken on this little toehold there with the JV that are doing on FILO. I mean, it's a natural, and you know, what's the market cap difference? I think BHP is like 140 billion and Lundin's 10. I mean, it'd be an easy tuck in for them. The real question is, what price would they want to get? And, you know, how did the NGX pieces come into play before or after? I mean, I think you do have to get all that settled before you get the kind of big development picture. But you know, that's really the type of stuff we look for when we invest in, because we know this is going to be a multi-year type of path. We don't need to get too cute trading in and out of these things. We can say, hey, we'll probably, I mean, the Lundin position, we have a lot of it's from investing in FILO that we inherited from the acquisition. And so it's like, if we can just continually roll these things up and, you know, 10 years from now, we own some BHP. I mean, I think that wouldn't be the worst outcome. But, you know, for now, it's like, hey, I think we can sleep easy at night knowing this is a pretty high grade, I mean, world-class project, and it's got deep pockets behind it. I mean, that's kind of a rarity in the mining sector.
How do you stomach the Argentina risk part of that? And I guess more broadly, how are you thinking more with separated supply chains and a bifurcated world in terms of commodities?
Yeah, I mean, hey, we don't. We're uncomfortable with it. I think we're uncomfortable with a lot of things. I think you have to kind of take the good with the bad. I mean, look, we own Alphamin and tin, right? So we definitely take jurisdiction risk if we think that the asset quality supports it. Look, you're always going to take some sort of risk in your investments, whether it's on the jurisdiction side, whether it's on the operational side, you know, and we always make the argument like, look, yeah, you can be in a great jurisdiction and have other problems. And do you really want a marginal project just because the jurisdiction's nice? And so I think we kind of, and when we build out these portfolios, we want to have a mix of these types of risk. Okay, yeah, maybe we'll take some elevated jurisdiction risk in one area if we believe the asset justifies it. Or maybe we'll, you know, lower our quality filter on a certain project if we think, oh, it's going to be a smooth path to production and, you know, there's none of those other things that we have to worry about. I think if you kind of build a portfolio around all this stuff, you can kind of mitigate some of those idiosyncratic ones. Look, Argentina looks like it's going in the right direction here, you know, at least with the, you know, kind of late overtures you've heard the last maybe 6-12 months, you know, this whole, the the kind of legislative framework for foreign investment, I think is going in the right direction. You know, that's another reason we like, you know, kind of doing things like with the Lundins is, you know, you got pictures of them with the presidents going back, you know, 40 years. I think those types of relationships really help. It's probably a lot different if you're some, you know, 2-bit prospect generator trying to poke holes down there. I mean, it's a much longer path, and you're probably going to be more at the mercy of the political rumblings than if you know, have big heft and you already have those sorts of relationships.
Yeah, and you mentioned the Congo and tin and Alphamin there before, so we've got to tuck into this one because there's a pretty fiercely loyal fan base out there. How are you thinking about the tin market and the evolution in that market since we spoke a year and a half ago?
Yeah, well, I mean, it's, you know, I mean, the tin price has actually been pretty resilient, holding around 35,000, I guess it is today. You know, Alphamin's one where, gosh, it's hard to believe that it's basically the same price it was 4 years ago. There's been a lot of volatility for not a lot of movement there.
Some good dividends along the way.
You did well. Okay, so you've got the dividends, yeah, and we've kind of played it well. You know, had kind of a core position that we've traded around. We were very large in it a few years ago, kind of after that first tin washout. You know, and so you know we've done well there, but I think the problem we have with that one is it's, you know, literally one of the best mining assets in the entire world, and no one really talks about the mining asset. I mean, it's all about the political situation. You know, I follow the chat around it. I mean, like a PhD in international relations just to sort of, you know, track along what are the latest peace talks and which rebel group's doing what. And so, it's kind of a distraction, and I wonder if that will prevent it ever from getting sort of a valuation re-rate, or are we just going to have to make all of our money from the dividends? And
There's a
remember, there
new
was
big shareholder there now as well, which has been one of the big changes in the past few months.
yeah. So we had it was Denim, which was the private equity company that had been in there for a while. I mean, for a while, it's 10, 15 years. I mean, since the thing was kind of built. I think that was getting long in the tooth there, and they wanted to do a continuation vehicle. I think that had been announced, and kind of right around that time, you had all the troubles start to pick up. I mean, this was maybe end of last year, and so maybe it went from a handful of parties down to, yeah, just that the Middle Eastern fund, which is, look, it, they don't normally have a lot of public companies, and so for us, it's like, okay, well, are they going to make a run for the rest of this company? That was pretty nice of them they were able to pick up that block. I think there was some concern, hey, are they going to, screw the minority shareholders, or are they going to continue the dividends? And then, we got a nice answer to that about a month or so ago when they paid the interim dividend. So it kind of goes back to what I was saying. Are we ever going to get a re-rate on this thing, or is the political overhang going to be just languish there, and we're just going to have to collect our return via dividends? I don't know. Whereas it used to be a very large position for us a few years ago when Tim was really washed out. I think it's more kind of middle of the pack now. We think it's a great risk reward, but there's obviously some challenges to look. Like I said earlier, I like when there's a lot of ways to win. If one of the ways to win is a re-rate, a multiple re-rate, I wonder if that way to win has gotten a little bit more challenged. Not to say that it can't get there. I think especially since after earlier this year they shut the mine down. There were all these concerns, and it looks like the international community, especially the U.S., stepped in and kind of give this implicit security guarantee. Look, that was enough to get things back up and running, but is that really enough to kind of assuage investors' fears and let them put a higher multiple on this? I don't know yet. The other problem is it's not that liquid. We talk to the management team pretty regularly, and it's, hey, can you guys do another listing, US, Australia, something? They don't need to raise money, right? And so there's no real reason for them to come out and introduce new shares to the market. So you're kind of in this limbo of, yeah, it doesn't really trade that much. Most of the float's locked up. How do you get new institutions in there if there's no stock for sale? I mean, really, the thing that Denim transaction was kind of the big transaction that you could potentially have. There had been some speculation before that maybe Denim wouldn't exit completely. They would take 10 or 20% of their stake and float that to get your secondary listing. But we'll see. I think at least with the latest news on the dividend, it looks like the new owners are going to be shareholder friendly. But we'll see. Again, whereas it was a very large position for us a few years ago, I think it's kind of more sized appropriately for the risk reward here.
How funny that he remembers the fully funded capital raises. You know what we talked about even more frequently than that with Adriatic?
Sandvik ground support?
We did bring up Sandvik ground support. The perfect segue was always an Adriatic segment, mate, because Sandvik ground support are supporting ground, and Adriatic had ground that needed support. So it was just a no-brainer.
This is true. Sandvik, a Swedish company, mixed with DSI, the champions from down under here, to create Sandvik ground support, the global champions of ground support. So if you're a underground miner in any neck of the woods, you should really get on the phone and give Derek Hurd a call, shouldn't you?
Mate, if you've got ground that needs supported, or ground that should be supported, or just ground in general, and it needs some support for safety, well, Sandvik ground support have the answer. It might come in the form of bolts, mate. It might come in the form of some of the great chemical products that they have out there.
It might come in the form of the digital systems that they've got in place. You can just hook these things on the end of your sort of bolts there, and you get a great understanding. All these things just hook in with your phone straight away, or it could come in the form of the latest app that they've got to chuck in your orders. They are making your life as an underground operator easier every day. So
I reckon they can support water.
You reckon? I wouldn't put it past this team, mate, because we know amongst everything else we just said there, they're at the cutting edge of R&D when it comes to underground mining technology. So I wouldn't put it past them, mate.
Absolute no-brainer. Go Sandvik ground support. back to Brian. I'm very curious, Brian. Like, if we rattled off a bunch of commodities, just give it a one to 10. One being like least, like no attractiveness whatsoever to buy anything in that space, and 10 being like, yeah, trying to get a full allocation into this commodity.
I like this. Let's do it.
Cobalt.
You know, I'm not the smartest guy in cobalt. I don't even know what number I'd give it. I mean, I know that there's been a lot of supply ramping up. What was that one cobalt project in the U.S. that they were trying to float that was a disaster? You know, I'd give it maybe a 2 or 3 with the caveat that I don't really know. Don't follow it too closely.
How about silver?
Hey, I like silver maybe better than gold. You know, I'll say maybe 6, 7 or higher. You know, Adriatic was the other one that got taken out for us, which was a nice validation because you know, obviously that thing got delayed. You guys, you know, rightfully joked about all the fully funded raises they did. You know, hey, we were in that for several years and did well, and it was nice to get the take out there. You know, and that was always the joke with them was they should change their name to Adriatic Silver because all the silver companies had these crazy valuation premiums that they were trading at. So yeah, look, I like silver of the precious metals the most because look, my problem always with gold has been what should the price be? It's not like any other commodity where you can use a cost curve and go marginal cost. It's like, you know, a lot of companies are making huge money right here. What should the price of gold be? I don't know. You know, probably higher just because on the margin, all the things are moving in its favor. But what's to say it should be 3,500 versus 3,000, 4,000 more or less? I mean, I think with silver, there is more of that industrial component to it. So you can really look at demand and there's going to be some real consumption there. And, you know, you see the guys that talk about the gold silver ratio and all that stuff. I mean, if you believe in that voodoo, you probably should see silver do a bit of a catch up. I think the gold bugs would hate if the catch up came the other direction and gold came down to it. But you know, I would expect silver to do very well there, and it's still a big part of our portfolio.
Did you top up your position in silver with the Adriatic? You know, the cash component of that, sort of pivot that into some more silver plays out there.
You know, we have some that we've been kicking the tire. I mean, the problem is there aren't a lot of silver companies, right? They have silver in their name, but they're mostly gold companies. They have some byproduct. And so we've looked at that, you know, who's got the most exposure on a revenue basis or a profit basis and, you know, kind of the sensitivity to that. And so we have some smaller cap plays there. You know, I think, look, we're happy to inherit the Dundee. I mean, that thing's just a machine. I mean, what a great operator they are. So we've basically taken that and, you know, I think on the margin, we're always on the lookout for it. But again, and I guess precious metals in general, it's not as contrarian as it was. I mean, we've been in gold and silver for a long time, you know, over a decade. You know, you couldn't really give it away back then, and now it's, you know, one of the best performers of the year, and everyone wants to jump in there. So you know, kind of the contrarian me gets a little nervous about that sort of shift in attitudes, but I still think these things have a long way to go. And yeah, if I had to pick one, probably silver over gold, and yeah, 6 or 7. I don't know, higher.
Zinc.
I don't know. I mean, look, it was part of the Adriatic case. I have to like it, but I don't really know it that well. It's not something that we've kind of followed too in depth because we've really only owned it companies where it's kind of a byproduct or we haven't really looked to target it directly. And maybe now that I'm hearing myself say all this, it probably is worth a look. But again, I think it's one of those things we probably wouldn't target directly. You know, and I view it kind of more niche. You know, I mean, the one that we're looking at niche that you guys probably know is niobium, which obviously the big discovery there that was a few years ago. We were in that one. We quite like that.
Really, you hold some WA1.
What's that?
WA1?
Ding, ding, ding.
Yeah. Well, I don't know how many other niobium companies there are, but you know, I feel like we you know, kind of came on our radar with that big discovery a few years ago, and yeah, it's, you know, there's a lot. That one's funny because obviously it kind of fits what we're looking for, which are these really high quality ore bodies. You know, they're calling it tier 0. It really is kind of an anomaly, a geologic anomaly, and the questions are not necessarily about the quality of the deposit. It's, you know, okay, it's kind of a weird market, right? The Brazilians have 80 or 85% of that one private company, and you know, how much can they flex up? How much can the market actually absorb? I mean, I think it looks good on kind of on a mine plan basis, but can they get an offtake? I think that's probably the next step for them to really de-risk it. But yeah, I mean, as far as niche metals go, that's probably the one that's least talked about. Some of the other ones, zinc, cobalt. Look, we always say you can't kiss all the girls, right? I think you have to pick your spots. We have the luxury of not needing to form an opinion on everything. I think that's kind of a tough concept for people to get their head around. Everyone thinks, okay, I need to know, every single thing, and I got to have a strong opinion. Look, I'll be the first to tell you, I don't know. I don't follow zinc that closely. I don't follow cobalt that closely, and so I'm not going to pretend that I do. I'm just going to, I can talk to you about the stuff that I do follow, but for the most part, look, we try to keep kind of a broad overview on a lot of different things. And it's just our view in general that, I mean, pull up the periodic table. There's a lot of those boxes on there that are going to be in short supply. And so we do a work on a lot of different ones, but I think you can only own so many stocks. We don't run like 100, 200 names in the portfolio. So we try to find things where, it's got kind of ticks all the boxes that we look for. And, we might have 4 or 5 different metals at a time.
A bit out of our wheelhouse, but how are you thinking about energy more broadly?
Well, I think it's funny. We don't own a lot of energy. And it's kind of ironic because I actually started as an energy analyst, oil and gas, a long time ago. But, I think the difference and why we prefer mining versus energy is just the lead time to bring on new supply. I think it's very difficult to bring on supply of metals, right? It's years to get permitting, build a mine, and do all that sort of thing. I think with oil and gas, I mean, you can drill wells in a pretty short time. And so really it's more of I think the fact that there's a easier supply response leads us to get less enthusiastic about potential price spikes. Whereas in some of these niche metals, if there ever is like a supply demand driven increase in the price, it's not going to get fixed that easily. And I think there is this period of time where you're going to have scarcity pricing and you can earn those bumper profits. That said, spent too much time looking at oil and gas wells to ignore it. And so I think that there probably is some opportunity there. What I kind of like in oil and gas now, we own some Canadian natural, which is like an oil sands type play. I like that business model of not necessarily blowing and going on this treadmill that the shale guys are on, where you got to keep plowing money back into the ground. For the big oil sands producers, they spent all that money. Now it's, kind of, it's just let the free cash flow roll in, very minimal ongoing CapEx and a flat production profile. And then you get kind of the natural gas figure if Canadian gas ever, gets off the floor. And so that's the way we kind of look at it is anything, and I guess you could even lump copper in there, anything where there's more of a generic, tied to the economy type of beta, and you're going to get whipped around. It's less niche. It's not uranium. It's not some of these things that have their own real tight fundamentals. I think we want to approach those areas like having something where it's kind of tangential to it, or you're not just okay, it's a call on the oil price or a call on the gas price. I think natural gas looks interesting here. It's been kind of washed out, and especially given all the demand for energy for AI, electricity. I don't think we're going to solve it all, with nuke plants in the short term. We're probably going to still be burning coal, still be burning natural gas. And of the two, natural gas seems to be the one that people think is cleaner. So you'll probably see more gas demand there, especially with the whole LNG thing. I mean, we've done well with some LNG adjacent type investments. And so, I think within oil and gas, we kind of pick our spots, but it's kind of it's a smaller part of the portfolio, much more so than mining, just because of that whole supply response thing.
Yeah, that sort of makes sense. And if we rattle off the last kind of couple, or the last basket of metals, I'm curious to hear your thoughts about some of the bulks. So you mentioned coal before, but do you take any interest in iron ore or aluminium?
I mean, not as much. I think again, those are kind of the ones that are more tied to just general economic activity levels, where I'm not going to have a smarter view than someone that stares at it all day, and so I think it's harder to get an edge there. yeah, maybe you can kind of time in and out a little bit better. And make some money. But I think the knowledge curve is so steep there. And again, why do I need the headache of trying to understand that when look, I understand enough of it as it fits in sort of the overall picture of, iron and steel and the coal and what's needed and all of that. But am I going to make the smartest call on where the bottom in iron is or where it's going to go? Probably not. I think we go a little bit more niche than that, but at the same time, not so niche where, some metal that we never heard of and there's 3 stocks and they trade, $10 a day.
Makes a lot of sense, Brian. It's been a privilege to pick your brain. Is there anything on your mind lately that you haven't had the chance to talk through so far, but you kind of just want to share?
I'm trying to think. I mean, I think we hit all the main stuff. It's really, where we're at right now is, yeah, uranium's done well. We're still in a little bit of it. I think probably copper would be our biggest metal that we're in, just because there's so many more ways to play it. I mean, tin's a tough one. I'm surprised you didn't ask about metals X because I know that's a big on the tin side there. I need to get your opinion whether you think they're ever going to get the cash back to the shareholders. But
I'm getting more I'm getting more comfortable with that capital allocation. Yeah, ding 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 on metals
yeah,
X as well.
I mean, that buyback bid at 40 cents is probably still sitting out there. I'd love to see them raise that a little bit. Now they're wasn't it you that went to their annual meeting?
Yeah, I did. I missed the one this year, but yeah, went the year before. It's always going to be a funky company, and it's not for everyone. But the capital allocation, which I was once pretty scathing of, like I'm a lot more comfortable with it these days, and I think it'll get better over time.
For a company that's not a fund, I mean, they've done well, building different companies. It's fine. I mean, I think the world's been clamoring for a 10 ETF, and so if it turns out to be metals X, and maybe that's the way to go. And the stock's done pretty well this year.
I still don't know yeah. I mean, you can interpret that in a few different ways. Like one interpretation is they're just land banking future development projects, which will actually prevent their development ultimately. Yeah.
Well, and I think in uranium, you kind of saw some people do that a while ago, and they got laughed at for it. And if it plays out the next 5 years, like the last 5 years in uranium, where all of a sudden you get a re-rate on these things, and there's all these $20 million, $50 million projects becoming the money because the tin price goes up a bunch. Well, they might look very smart for doing that. The real question is that their real intention, or what is it? I think that's the problem. Is without any sort of really explicit capital allocation framework, you're kind of at the mercy of just guessing at it. But in the meantime, it's done pretty well. It's pushing close to the kind of the 5-year highs that it hit several years ago. And so I think if it only trades as a proxy for the tin price in the meantime, we'd be very happy. And then you get a little bit of a bonus if they pay you back on that. But really, no, I think we hit on most of the things. I mean, copper is probably our biggest one. And again, it's a lot of the, I don't know if I'd call them household names, but we like the mid tiers, kind of the $10, $15 billion caps, like an Ivanhoe that has a very high quality project. I think you can do well finding these things. I mean, obviously they had their troubles with the mine issues earlier this year. In our experience, those have been great times to pick off some shares of a longer term story, because whatever the short-term issues are that people are concerned with. And then, the rest of it, I mean, I think we're actually finding some interesting ideas outside of mining that actually we got led into by doing the research on mining. You start researching all these niche metals and you see the applications they go into, and you start learning about the applications. You're like, well, no, wait a minute. Some of these interesting technologies, kind of the forefront of tech, whether it's aerospace or, lasers, all this kind of crazy stuff. It's like, okay, there's some interesting companies that are, almost picks and shovels kind of going into those applications, where I would almost consider the metals as a pick and shovel play into some of those applications as well. So, it's a lot going on. We don't do a lot of these podcasts because the stuff doesn't really change, from week to week. If you think about it, it's the same story we've been telling for very many years. And now it just, some of the stuff starts to work and be like, oh my gosh, you're not as dumb as you look. So it's like, okay, real question. And I think those are great questions about the contrarian stuff, because that's really what we're doing, is looking at the stuff that, the seeds that we planted a few years ago that are all of a sudden bearing fruit. And now it's like, okay, if we want to trim some of these apples off a tree and make a pie, like what's the next area we're going to go into? I think it's some of those ones like a coal or a lithium where, people hate it right now, but you can make a picture that maybe 3 to 5 years from now looks different.
I think you summarized it well, perhaps when we last spoke, by saying if we're not talking about this stuff in 5 years' time, we've kind of done our job.
Well, hopefully it's because we harvested at a gain and not and we were completely wrong about it. But no, that's exactly what we said. Look, we run a few different strategies. Kind of our more wider one is about half 50% in metals and mining, which is a huge overweight for anybody, right? And so we tell people, yeah, look, this is where we are today. That's where we see the value. But yeah, 5 years from now, I'd love nothing better than to not own any of this stuff, because it means that the valuations really did what we thought they would do, and we captured all that latent value, and we're on to the next area. And so, look, I think at least with mining though, because it feeds into so many different areas, I think there's a long runway ahead. And so, look, we said the same thing about uranium, but then you get these short time periods where there's a frenzy and you get this quick valuation re-rate. I think maybe you'll see that in some of these other areas, and then we keep kind of hopping around to where we see short-term weakness, long-term strength. And when those run out, yeah, maybe it's something completely different. You guys won't invite me back anymore because I don't have any mining stocks.
I'm sure you'll get a call up in a year or so's time, Brian, to check in on all these, but appreciate you making the time and joining us and chatting about the portfolio.
Thanks, Brian.
Yeah.
Fantastic, mate. I love chatting with Brian. I love chatting with generalist investors. Love chatting with contrarians. So it's always great to sort of share the thoughts of these smart people on money of mine. And it's all possible thanks to our fantastic partners, Sandvik Ground Support in the show, as well as Focus, the platform by Market Tech, and iMark. Get your tickets.
Hooroo, money miners.
Hooroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot, and you need to read out a disclaimer.